Hey everyone, welcome back to Corporate Decoder, the place where we break down the jargon and find the juicy corporate secrets. And in this filing, we have National Energy Services Reunited Corp, with a report that is packed with numbers, but what story do they tell us about the company's health and future? Stick around as we dive deep into their latest financials. So first off, let's get a grip on where this company stands. This report is a 6K filing, which is essentially a report of foreign private issuers, and what it gives us is a snapshot of National Energy Services Reunited Corp. Its financial situation. Think of it as a checkup for a company to see how it is doing in terms of its money and its operations. The heart of this report really lies in its financial statements. These are not audited statements, meaning they are preliminary, but they give us the most current view of the company's performance. Let us start with the balance sheet for the 30th of September 2025. Their total assets were about $1.8 billion. That is a big number, and it represents everything the company owns from cash to equipment. On the flip side, their total liabilities were about $852 million. This means they owe money to others, which is normal for any business. The difference between assets and liabilities is equity, which stood at around $956 million. This is what effectively belongs to the owners of the company. Looking at their cash position as of the 30th of September 2025, they had about $70 million in cash and cash equivalents. This is down from about $108 million at the end of 2024. While they still have a decent amount of cash, a decrease like this is something to keep an eye on. Now let's talk about money owed to them. Accounts receivable were quite high at over $192 million compared to about $137 million at the end of 2024. This means customers owe them more money now. While this can indicate strong sales, it also represents money the company has earned but not yet collected, which can impact its cash flow. One of the most interesting items on the asset side is goodwill. They have about $645 million in goodwill. Goodwill typically arises when a company buys another company for more than its book value. It suggests they have made significant acquisitions in the past. On the liability side, their long-term debt stood at over $207 million after accounting for current payments. This is a decrease from about $254 million at the end of 2024. It is good to see their long-term debt going down. In equity, we see they have over $899 million in common stock and additional paid-in capital. They also have almost $57 million in retained earnings, which is good news. Retained earnings are profits the company has kept over time. Now let us look at how the company made its money and what it cost to do so. For the 3 months ending the 30th of September 2025, revenues were about $295 million. This is a decrease from about $336 million in the same period last year. For the 9-month period ending the 30th of September 2025, revenues were $925 million, down from $958 million in the previous year. So sales are down a bit. Gross profit is what is left after subtracting the direct costs of making their services. For the September quarter, it was about $35 million, down from $53 million a year prior. As a percentage of revenue, this is about 12% for the latest quarter and 15.9% for the prior year. This means their profit margin on their services has squeezed a bit. Their selling general and administrative expenses, also known as SG&A, were about $11 million for the quarter, down from nearly $13.3 million. This is a positive sign as they are controlling these overhead costs. Interest expense, which is the cost of borrowing money, was about $8.1 million for the quarter, down from nearly $10 million. This decrease is good and likely due to their lower debt levels. Interestingly, for the September quarter, they recorded an income tax benefit of $5.5 million, even though they had income before taxes. This is a bit unusual, and the report states it is due to adjustments in uncertain tax positions, which sounds complicated, but essentially means some tax-related accounting adjustments. All of this led to a net income of about $17.7 million for the September quarter. This is down from about $20.6 million a year ago. For the 9-month period, net income was about $43.3 million, a drop from $49.5 million in the prior year. So profits are down, but they are still profitable. Looking at the statement of shareholders' equity, we can see the movements in the company's ownership structure. The warrant exchange mentioned here is a big deal. In May 2025, they offered to exchange warrants for company shares, and a lot of warrants were exchanged. This changed the number of shares outstanding and also impacted their additional paid-in capital. Now let us talk about earnings per S-share or EPs. This is a key metric for investors. For the September quarter, basic EPs was $0.18, down from $0.22 a year ago. Diluted EPs also saw a similar decline. This reflects the lower net income. The company operates in distinct segments. They have production services and drilling and evaluation services. Production services generated about $174 million in revenue for the September quarter, down from $230 million a year ago. Drilling and evaluation services, on the other hand, saw revenue increase to about $121 million from $106 million. So while one segment is slowing down, the other is picking up some of the slack. The total revenue from reportable segments for the September quarter was $295 million, down from $336 million. This aligns with our earlier revenue findings. Looking at segment operating income, production services saw a significant drop in operating income to about $15.6 million from almost $40 million a year ago. However, drilling and evaluation services operating income increased to about $16.3 million from $14.3 million. The decrease in production services revenue and income is attributed to reduced hydraulic fracturing and coiled tubing activity. This sounds like a slowdown in their core services. The increase in drilling and evaluation services is attributed to more well testing and higher use of their Roya technology. This segment seems to be performing better. The majority of their business comes from the MENA region, which is the Middle East and North Africa. Over 99% of their revenue comes from this region. This concentration makes them very dependent on the economic and political stability of these countries. Now let us look at cash flow. For the 9 months ending the 30th of September 2025, they generated about $125 million from operations. This is lower than the $183 million generated in the same period last year. This drop is partly due to increases in accounts receivable, meaning more money is owed to them but has not been collected yet. Investing activities used about $107 million of cash compared to about $84 million last year. This increase in cash outflow is primarily due to higher capital expenditures, which means they are investing more in their assets and equipment. Financing activities used about $57 million of cash compared to about $49 million last year. This is a bit more cash going out. Scaled net change in cash and cash equivalents scaled. Overall, the cash position decreased by about $38 million in the 9-month period compared to an increase of about $50 million last year. This confirms the decrease in their readily available cash. Let us revisit their debt. They have a secured term loan which has been reduced. The good news is that the company seems to be managing its debt repayment well. They are complying with their loan covenants, which are basically rules they must follow regarding their financial health. A point of interest here is their income tax situation. They are incorporated in the British Virgin Islands, which has a 0% corporate income tax on foreign income. Their subsidiaries operate in the MENA region, where tax rates do vary. The company has commitments for future capital expenditures of about $64 million, which they expect to spend in 2025 and 2026. They also have outstanding letters of credit and guarantees, which is typical for companies in this industry. The warrant exchange from May 2025 is a significant event impacting their equity structure. It shows a strategic move to potentially reduce outstanding warrants and issue more shares. Now, for my take, this report paints a picture of a company facing some headwinds. Revenues and net income are down for the year-to-date periods compared to last year. The production services segment, which seems to be a major part of their business, is experiencing a slowdown. This is concerning. However, the drilling and evaluation services segment shows growth, which is a positive sign. The company is also increasing its capital expenditures, suggesting they are investing for future growth, which is a good sign if they can execute. Their heavy reliance on the MENA region is a double-edged sword. It provides them access to a stable and significant oil and gas market, but also exposes them to geopolitical risks. Investors should be aware of this concentration. The decrease in cash and the dip in revenue are indicators that the company might be navigating a challenging market. While they are profitable and managing their debt, the declining top line and bottom line figures warrant attention. Overall, National Energy Services Reunited Corp appears to be a company that is navigating a changing market. They are investing for the future and their drilling segment is showing promise. But the core production services segment needs to pick up. The warrant exchange is a complex maneuver that will play out over time. Investors should watch their ability to turn revenues around and maintain profitability in the face of these challenges. Alright, that is our deep dive into National Energy Services Reunited Corp's latest filing. What are your thoughts on these numbers? Do you see a brighter future or are there red flags waving? Let me know in the comments below. If you found this analysis helpful, please give it a thumbs up. It really helps us out. Subscribe for more corporate breakdowns and of course join our Discord community linked in the description for even more discussions. Thanks for watching and we will see you in the next one.